Hey everyone, stock market has been testing the patience level of investor for a long time now, and it looks like there is more pain ahead. Inflation is a big problem both in US and India, and central banks have to increase the interest rate to control the inflation. Recently, RBI has increased the repo rate by another 50 basis point, and now the new rates are 4.9%. And it looks like RBI might have to increase the repo rate further in the coming months. So the bottom line is that stock market might remain range bound for the next few months. How long it may remain range bound? Well, until we get a clear picture on inflation slowing down and reaching below the levels of 6%. Moreover, there would also be negative impact of US inflation and slowdown in US economy in the Indian stock market. It means that if you are someone who is in the accumulation phase of your stock investment journey, then it is one of the best time to accumulate quality stocks in your portfolio. Stocks that you always wanted to invest but could not invest because they were always overvalued. Stocks that are the leader in their business and have been the consistent compounder for more than 10 years and bound to bounce back when the situation normalizes in the future. So in this video, I want to discuss 5 consistent compounders that have corrected significantly and are now trading at 52-week low. But before we proceed, please be very clear that if a stock is at 52-week low, then it doesn't mean that it can't fall further. It can even fall more. But the beauty of investing in top blue chip stock is that they have faced such difficult times in the past and have always come out with flying colors. It means every fall creates an opportunity to invest in these quality stocks for long-term wealth creation. Alright, let's get started. Number 5th stock in my list is from paint sector. This stock is the undisputed leader in the decorative paint category in India. Can you guess the name? Well, it is Asian Paints. Asian Paint has been one of the most consistent compounder in the Indian stock market in the last 20 years. Year on year, Asian Paint has generated great returns for its shareholder. And this is one stock that doesn't fall a lot. In fact, even during COVID crash, Asian Paint tanked only around 18 to 20%. In last 10 years, Asian Paint share price has jumped from levels of 380 to highs of 3,600, generating nearly 10 times return. But it is currently down nearly 25% from its peak and available at levels of 2,700. There are 2 major reasons for fall in Asian Paint share price. First reason is due to rising crude oil prices. Crude oil derivatives are one of the major raw material for Asian Paints and contribute significantly in the cost. And since the prices have gone up, the production cost has increased a lot. That has resulted in fall in operating margin of the company and eventually resulted in fall in profit growth. Although Asian Paint pass on the rising cost to end consumer, but the jump in crude oil prices are too steep and hence Asian Paint has to take a hit on its profitability. Second reason is due to recent announcement of Aditya Birla Group, where they have mentioned that their flagship company Grasim would be increasing its capital expenditure in its paint business by around 10,000 crore over the next 2 to 3 years. Grasim has recently entered into the paint business and being part of Aditya Birla Group, Grasim is a company with deep pockets. Its entry and focus on paint business will increase competition in the industry. Asian Paint has currently almost 50% market share in the Indian paint market. But with increased capital expenditure by Grasim, there is a high probability that the market share of Asian Paint will come down over the next few years. This expectation has caused the market price of Asian Paint to go down. But I believe that Asian Paint has a very strong dominance in the decorative paint category in India, and paint is one sector that will continue to grow. Especially now when people are looking for personalized home and office space and are very particular about designing their space. Also the fact that Asian Paint has now forayed into various other categories like wallpapers and waterproofing solution. So Asian Paint is not just a paint company, it is a complete home decor solution provider. It has even forayed into home and personal hygiene like your hand wash, floor cleaner, etc. Now if you look at the financials of Asian Paint, in last 10 years, its revenues have consistently grown from 9,231 crore in FY12 to 29,101 crore in FY22 at 12% CAGR. Its profits have consistently grown from 989 crore in FY12 to 3,031 crore in FY22 at 12% CAGR. I believe that once the crude oil prices would normalize and overall inflation get under control, Asian Paints will bounce back. Yes, it might not happen immediately and there might be more pain ahead, but a quality stock like Asian Paint is worth adding, especially when it has corrected nearly 25% from its peak. Again, you don't need to buy this stock in one go. You can systematically add Asian Paints over the next few months. Number 4th stock in my list is an undisputed leader in the Indian adhesive segment. It is Pidilite. Pidilite brands like Fevicol, Fevikwik, Fevistick, Dr. Fixit are so popular that people do not say that give me an adhesive. They say that give me Fevicol or Fevistick or Fevikwik. That's the power of brand Pidilite has built. Fevicol, Fevistick are essentially a commodity product, but Pidilite has made them one of the strongest brands in the country. And Pidilite is also one of the top consistent compounder in the last 20 years. In the last 10 years, Pidilite share price has jumped from levels of 160 rupees in FY12 to highs of 2,764, generating 17 times return in just 10 years. However, in last few months, Pidilite share price has also corrected 25% and is available at 52-week low of around 2,080. If you look at the financials of Pidilite, in last 10 years, its revenues have consistently grown from 3,127 crore in FY12 to 9,921 crore in FY22 at 12.2% CAGR. Its profits have consistently grown from 324 crore in FY12 to 1,208 crore in FY22 at 14% CAGR. Now, if you look at the future growth, there is huge scope for growth in construction segment, which is eventually going to drive the growth in adhesive and sealant segment for use in furniture and waterproofing solution. Pidilite is the biggest player in the adhesive category with a market share of 60 to 70%. And now that there's an uptick in the real estate sector, it should directly benefit companies like Pidilite. Number 3rd stock in my list is from banking sector. It is HDFC Bank. Again, a leader in private sector bank in India and one of the most consistent compounder over the last 20 years. In last 10 years, HDFC Bank share price has jumped from levels of 270 to highs of 1700, generating around 6 times returns. However, over the last few months, HDFC Bank share price has fallen around 20% from the highs of 1700 rupee to current levels of 1350 with 20% correction. In last 1 year, the share is down 8%. Now there are multiple reasons. First of all, there is a change in leadership of HDFC Bank where Aditya Puri, the man who built HDFC Bank from scratch to where it is now over the last 25 years, has retired. Then HDFC Bank faced some technical issues on its online platform and RBI banned HDFC Bank from issuing new credit card, although that ban has been removed. And then recently they announced the merger of HDFC Bank and HDFC Limited. So due to all these reasons and of course due to heavy selling from FIIs from Indian market has resulted in a correction in HDFC Bank. But let me show you how HDFC Bank has grown consistently over the last 10 years. Its revenues have consistently grown from 28,193 crore in FY12 to 1,35,936 crore in FY22 at 17% CAGR. Its profits have consistently grown from 5,247 crore in FY12 to 38,053 crore in FY22 at 22% CAGR. As far as future is concerned, banking sector is the backbone of economy. And if we expect Indian economy to grow, banking sector is bound to grow. Yes, it is also important to invest in quality lenders that have a brilliant track record in the past in terms of parameters like asset quality, return on equity, credit growth, etc. And HDFC Bank checks all these parameters. Srinivasan Vaidyanathan, who is the CFO of HDFC Bank, mentioned that HDFC Bank is planning to add over 4,500 to 6,000 branches over the next 3 years. That would be almost double of total number of branches HDFC Bank has currently. And the reason is there is huge potential in the Indian market, especially in rural areas. Hence, I am very positive on HDFC Bank to generate consistent compounding over the next 10 years. Number 2 stock in my list is from pharma sector. This stock is the leader in Indian API segment. It is Divi's Lab. Divi's Lab specializes in manufacturing of generic APIs, nutraceutical ingredients, and offer custom synthesis of APIs to big pharma giants. Just to give you an idea, Divi's Lab is global leader in generic API manufacturing. It manufactures around 30 APIs and out of this, Divi's is world's largest manufacturer of 10 APIs. Over the last 10 years, Divi's Lab share has jumped from levels of 500 in FY12 and touched a peak of 5,500, generating more than 10 times return. However, the stock has corrected 35% and currently trading at levels of 3,500. The reason for such deep correction is because Divi's Lab saw a huge demand during COVID period that resulted in a sharp jump in its revenue and profit. and resulted in huge surge in its share price. However, that growth was unsustainable. Now that the economy has normalized, the growth might fall in the near term and also the margin would normalize, and that would impact the top line and bottom line growth of Divis Lab in the short term. If you look at the financials of Divis Lab in last 10 years, its revenues has grown from 1,864 crore in FY12 to 8,960 crore in FY22 at 17% CAGR. Its profits have grown from 533 crore in FY12 to 2,960 crore in FY22 at 18.7% CAGR. If you look at the future growth, there is going to be huge demand for pharma sector due to rising lifestyle diseases and increasing penetration of generic medicine in the regulated market. Specifically for Divis Lab, there is a huge opportunity of $20 billion worth APIs going off patent over FY23 to 25. And Divis has planned an aggressive capex of around 2,000 crore over the next 2 years in order to take a chunk of it. So overall, the growth prospects in the long term are looking very bright. Also, the fact that global players are looking for alternatives to China, and even the Indian government want to reduce its dependency on China for import of KSM and APIs, and that would fuel the growth for Divis Lab. Now, number 1 stock in my list is from infra sector. It is UltraTech Cement. UltraTech Cement is again an undisputed leader in cement sector in India. Over the last 10 years, UltraTech shares have jumped from levels of 1500 and touched a peak of 8000. However, UltraTech Cement share has corrected nearly 33% from its peak and now down 18% in last 1 year. One of the major reasons behind correction in cement sector is due to Adani Group acquisition of Holcim Group that owns ACC Cement and Ambuja Cement. So Ambuja and ACC have a combined capacity to produce at least 70 million tons of cement annually, which is second to UltraTech Cement, which has 120 million ton capacity. So Adani Group has acquired 63.19% share of Ambuja Cement and its subsidiary ACC for $10.5 billion. And with this acquisition, Adani Group will become India's second biggest cement maker. This deal will increase competition and lead to further consolidation along with the possibility of price war. Another reason is due to rising input cost that would impact the profitability of cement company in the near term. Hence, the entire cement sector has seen correction over the last few months. Now, if you look at the financials of UltraTech Cement, in last 10 years, its revenues have grown from 18,551 crore in FY12 to 52,599 crore in FY22 at 11% CAGR. Its profits have grown from 2,403 crore in FY12 to 7,344 crore in FY22 at 11.8% CAGR. Now, as far as future is concerned, Indian government has a huge focus on infrastructure building, and cement is one of the most essential product in building the infrastructure. Moreover, the rising demand for housing would also benefit cement companies. UltraTech board has recently approved capex budget of 12,900 crore for setting up 22.6 million ton of new cement capacity. That would be additional 18% of its existing capacity. So the future prospects looks very bright. So in this video, we discussed the top 5 consistent compounders that are trading at 52-week low. If I summarize, the list includes Asian Paint from paint sector, Pidilite from chemical, HDFC Bank from banking, Divis Lab from pharma, and UltraTech from cement sector. So a well-diversified list covering 5 key sectors, with each sector having a very bright growth prospect. And since all these companies are the leader in their respective sector, they are bound to grow. Especially during the difficult times, the small businesses struggle to survive, and it is the big sharks that eat those small fishes. So big companies with strong financial strength capture more and more market and become even bigger. Although the current volatility in the stock market is expected to continue for some more time until the crude oil prices normalize and inflation comes under control. During 2021 bull run, these stocks jumped a lot and became expensive. But this correction has created great opportunity to accumulate these quality stocks in a systematic manner. So tell me in the comments which stock you are accumulating in this current fall. I hope you'll find this analysis useful. I'll see you in next video. Till then, take care.